Welcome to the second breakout session of the afternoon. My name is Joe Bishop. I'm a workplace savings counsellor, and I'm delighted to be able to introduce the panel this afternoon. The focus here for the panel is around divestment and decumulation, and I think it's testament to the interest in this area and its growing prominence with the amount of people we've got in the room this afternoon. In 2016, Kiwi Wealth, the organisation I work for, did a survey of its KiwiSaver members, of which we found 77% of them didn't know what their KiwiSaver would be worth when they retired. So if 77% of KiwiSaver members didn't know what it would be worth when they retired, it's fairly safe to assume that they had not paid mind to what they would do with that money when it vested through to them. So it's an incredibly topical conversation now, especially as balances in KiwiSaver are starting to grow, and people are starting to pay more attention to those balances and start to think about what they need to do. So we've got a panel of experts this afternoon, some of whom need no introduction, some of whom will be fresh faces to the audience here. Facilitating for us this afternoon is one of those who needs no introduction. However, I'm sure this is the second of three you're likely to get at various points over the course of today. David Boyle, of course, most recently joining Mint Asset Management, but well known for all of us for his tireless work on behalf of the Commission for Financial Capability. Alongside David there, we have Susan St John. Susan has 35 years at Auckland University, looking after economics and public finance, and is also a well-known thought leader in the policy space. Next to Susan, we have Ralph Stewart. Ralph, the former CEO of AXA, well known to many of us here, and has been fighting the good fight on behalf of divestment and decumulation, having launched the Retirement Income Group. And potentially a fresh face for many of us here today, over the ditch from Australia, we welcome Wade Matterson. Wade leads Milliman in Australia's practice, focusing on navigating the challenges of an ageing population, working with fund managers, working with governments and other policy setting organisations. So I welcome all of the panel to the stage, and I'll pass over to David.
Thanks, Joe. And crikey, we all look like we've got a bit of interest in retirement income, maybe as much as I have, because I seem to be getting closer to it every day. And it is a topic that I think as an industry we genuinely need to really start thinking about, and not just talking about, but actually providing some solutions. So my role today is really to facilitate the panel. What we've decided to do here is each panellist here is going to spend about 5 minutes talking on the topic, on the area of expertise, and thinking about what are the other solutions and environmental aspects that we need to take into account. More particularly, what can we do as an industry going forward? After we run this, I want to spend more time, hopefully, with the questions that you can give us. Then ultimately, the content and themes that we think are important in this meeting today, or this workshop, is that we can then take that back through FSC and other organisations. So hopefully, we might see some, maybe some focus and improvement in this area. So, just to kind of frame things up, what is really the problem? The real problem is that we're living longer, If we weren't living longer, we wouldn't have to worry about income. We would not have to worry about retirement. And it's probably been only in the last couple of 100 years that it's been an issue that is going to actually now cause quite a lot of challenges for us as we live longer and I guess age longer, and also need that income to live as long as we do. When I was working at the Commission, we did, as part of the Retirement Income Policy Review, we looked at decumulation back in 2016, and we did a survey to the general public. And there were some quite interesting statistics that came out of it, which I thought might be useful to frame up so that the rest of the speakers will be able to perhaps talk on those areas and see how we might be able to improve in this. There was about 1,500 people that completed the survey on behalf of the Commission in those days, and 75% felt that their living standards were either going to stay the same or decrease. More concerning was a whopping 43% said national super would be their only main source of income. 51% that said they were either very or quite concerned about living longer than their savings, and over 40% had no financial plan at all. 84% felt the government should provide more incentive to save for retirement. I'm sure that could be a topic of discussion today. And 61% felt there should be more investment options. And I think as a challenge to our industry, as much as providers, we should be thinking about what other options are available. And I'm sure, again, the panel will have some thoughts about that. The other thing that we know in New Zealand, from many of our New Zealanders that are either nearing or in retirement, their greatest asset is one that's particularly illiquid, and that's being their own home. And in this case, about 50% of those that were looking at retirement said that they would look to downsize or take some asset out of their own home to maintain and build their savings. The other really concerning thing that really just does my head in sometimes is around KiwiSaver, because it is a genuine part solution for this. But we, again, surveyed where we got some providers to give us some insight. What were New Zealanders doing with those that drew their money out at age 65? And about 43% of those New Zealanders, guess where they put their money after they took it out of KiwiSaver? To the bank, and to bank deposit. I mean, what's that about, really? You know, as part of an education, you can keep banging your head, and trust me, I know what it's like, to keep going on about this topic. Because we're living longer, we need our money to be working longer and working as hard as, you know, as we need it to live as long as we do. And so there's not one silver bullet with this. And with the expertise and the panel that we've got today, I believe that we're going to get hopefully some really intriguing, interesting and fun insights. But don't be shy about asking us the questions as well as we go through this. So I wonder if I could ask Susan to kick off this panel and give us her thoughts and insights around what we think we could do here.
Thank you, David. And this is a topic very dear to my heart, so I'm delighted to be talking about it. And just as David has said, I think it's really important to know what the problem is. So I look at it and I see that there is a serious hole in our otherwise excellent retirement arrangements in New Zealand, and that hole is for middle income New Zealanders. It's not for the better off. They're always going to be okay, no matter how long they live. And it's not, unfortunately, for that lower 40% who don't have anything else. Those problems have to be solved elsewhere. What I think the problem is for middle-income New Zealanders who face a retirement where they come in with maybe $100,000, $200,000 and they face risks of outliving those savings. They face the risk of being too frugal and not having a decent retirement because they're worried about it. They face the possibility of long-term care costs. Now, I suppose people in this room are all informed, but for some, it comes as a real shock to find that it's $50,000 and now plus 9% a year for rest home care level. Now, we have a draconian income test, and it's an asset test as well. So you've got to spend down to a very low asset level to get state assistance for that care. This is a huge risk, and it cries out for an insurance solution. So this middle income group, they've got to manage this lump sum, and it's a real problem, and we know that there's a growing problem of dementia. We're looking at 170,000 by the middle of this century. That's a number that is increasing from now very rapidly. And of course there's the worry about financial abuse by family members as well. So we were asked for 3 takeout points: identifying the problem. The second one for me is that I think New Zealand has a unique opportunity to develop a really unique world-leading solution, or at least partial solution to this problem. Because We do not have incentives, or only very modest incentives, for the accumulation phase, which means that we can be a bit more generous about thinking about subsidising the decumulation phase. We've got a very good infrastructure with KiwiSaver. It's very well received. Everyone in New Zealand understands the term. The provider regime is very well set out and very well monitored. We need to build on that. And I would propose that we think about something that we might call Kiwi Spend, an annuity which would be a default from your KiwiSaver at the point of retirement. Now, it's not the point here to go into the detail of how that might be designed, but there is myopia. People do not understand their need for constant income in retirement, or they're afraid. But if the state were to stand behind this, not only with the subsidisation around maybe inflation proofing, but also with guarantee, so that the company wouldn't just disappear and leave you in the lurch, would be gender neutral, and it might have other advantages as well, and in particular have an add-on for long-term care insurance. So that's the second point, just raising that as a possibility and hoping that New Zealand might get behind discussing this. And the third point, the take-out point that I'd like to make is that time is running out. We have been talking about this issue for years. For the last 15 years, I've been coming to conferences like this. And I just need to pick up the notes from the last time, really. And it is a shame, because the earlier you get into insurance, of course, the less costly it is. So the baby boomers are retiring very rapidly, and we're well into that baby boomer retirement, and we're missing the boat. We need to do research on the existing annuitant population before it all dies off. We need to ask, what are the advantages to having an inflation-proofed annuity from those lucky government superannuitants? And I would suspect that we would get very positive response. And there's a load of other things we need to do urgently, such as not make property so tax advantaged so that these things can look attractive, and debate how we can get the state in there to act as a catalyst. Now, I'm very, very interested to hear about how the private market does deal with the problem of offering annuities. It's a very, very difficult one, and I think we'll hear from Ralph that to get a private annuity off the ground is a very slow, expensive process. Well, what's happened to date is possibly a drop in the bucket. We need to act more urgently.
Thanks, Susan. That was a very good overview, and like you say, we've heard it all before, but let's hope we can move on from there. Ralphie, you've seen many sides of this fence, and looking forward to your thoughts on this.
Thanks, Dave, and thanks, Susan. I think the words were interesting, exciting and funny. We'll do my very best, mate. Thought the best approach to dealing with sort of three key points in this part of the session was to really just try and reflect and share some of our experience of the last 5 years. We spent 3 years in R&D trying to develop a product that would deal with market volatility to provide a guarantee, and also the real issue associated with the guarantee, which is the longevity of life. We've now done that, and we've now been in the market about 2.5 years. And to the left of me, Wade has been a big part of that, was an early supporter back in 2013, providing advice on the original design for the product, and as we see today, still manages the liability for us and hopes to do so for the future. The three kind of headings I was going to try and hit, which I hope are helpful, was really some of the challenges we've faced and what we've learned around investment management first. Secondly, the nature of the market, the nature of communication, and the nature of the way people behave in relation to guarantees. And perhaps thirdly, just touch on some of the truisms we've had to square up to get where we are, if that's okay. And I hope that in part helps Susan explain some of the points that you've raised. So in terms of investment management, we had to get across the bridge fairly quickly, because traditional investment management when you're saving does not work in retirement space. Dollar cost averaging is a fantastic animal. It's tremendous when you're saving. You can afford to lose a little on the way up because you know time will solve the problem. When you're retired, time becomes the problem. There's no chance to do that. If you're using your capital for a regular withdrawal, the dollar cost averaging happens in reverse. You're forced to sell units, therefore you have to realise assets at whatever the price is, and they're gone forever. Second point is, as you're approaching retirement, say within 10 years of 65 or so, if there was a major market event, a tremendous 2008 type event, that really seriously damages your ability to generate income for the rest of your life. That time has passed. And lastly, in a very practical sense, the notion of drawing capital down over time in retirement means you have to identify some point at which you're going to run out if you're going to use your capital, and no one knows what that is. So there's obvious and real risk in trying to interpret that without accuracy. So that presented some real challenges to us. Second piece is the nature of demand itself. Susan's touched on it, but 10 to 12% of New Zealanders have enough money, so private banking, stockbroking, high net worth advisors, fill your boots, it's great. But for about 35% of New Zealanders, Susan's point out, NZ Super, their home, and perhaps $300,000 to $500,000 is the lot. And in practice, $300,000 to $500,000 is not going to earn enough to meet the gap between NZ Super and a reasonable living in retirement. So helping people understand drawing down their capital is fundamental, and it's a difficult communication piece. And lastly, and really sadly, I don't know how you put it in a positive way, but 40 to 50% of New Zealand, NZ Super and the house is it. That's all there is. So there's no point to trying to convert them into annuity or do anything like that, because there's just no possibility of doing it. So the reality of home equity release is clear and present in our view, and it just has to be part of the retirement income product mix. It's essential for nearly half the retirement population. So the last piece was sort of some of the fundamental kind of learnings in that space is to really be an investment manager in retirement space, to deliver guarantees that are reliable and will sustain 20 to 30 years of life is capital intensive. So you do need a lot of capital, as Susan said. For us, in a very raw sense, and it is very raw, it's about 8%, or $8 in every 100 of shareholder funds is overseen by the Reserve Bank to facilitate a guarantee. Susan's exactly right. Second point, it is complex. There's a degree of complexity which exceeds what you normally find in a normal investment management environment. I'm not saying it's not complex there, but when you introduce hedging to offset the cost of capital to try and make it economic for shareholders, it gets pretty challenging. And lastly, the whole notion of communication. We sell our product in New Zealand by talking to retirees, largely by seminar. We do hundreds every year. We speak to thousands of people every year. And the level of understanding in New Zealand about retirement income or about retirement per se is really low. And it is really challenging to communicate to those people in a way they can have confidence in, can understand, not feel stupid, feel inclusive and feel included. It is a big part of being in the retirement income space in New Zealand today. Very exciting, and as Susan said, there's so much to be done. We're just clipping the surface.
Thanks, Ralph. Wade, let's see what you can put into the old savings bucket.
Yeah, great. Well, thanks, David. Let me start by, I might come back here more often if I keep being described as a fresh face. I don't think I've had that description for about 10 years, but I just thought to just start maybe to give you some perspective about how we've thought about it from an Australian industry perspective, because I guess we're dealing with all the same issues that you guys are. And for background, I guess I started in the Australian market over a decade ago. And when we first started there, when I genuinely was fresh-faced anyway, our initial instinct, being sort of the actuarial number crunchers that we are, is that it's all about products. If we build the right products, then people will come and access them, right? If we build these solutions that manage market risk and provide longevity guarantees and all this sort of stuff. So we went about and did that for a number of years. And the reality was that they actually didn't sell, right? Products in and of themselves are very difficult to position as the solution. So, whilst there is a huge need for them, we actually have to start looking at a range of other things to then convince people, as David pointed out, people take their money out, they put them into term deposits, even though there are better alternatives out there. So we have to figure out what the other building blocks are that we need to work our way through. So where that led us was, again, focusing on the quantitative aspects. So we moved to start looking at how advice was given. And as we started to look at the way advice was given, what we discovered looking at initially sort of face-to-face advice and then looking at more digital mechanisms for that, was that advice was heavily driven by the need to be compliant with the regulations. Right? And the existing tools and systems that people use to assess the problem and quantify, for instance, the impact of a market drawdown or living a lot longer than average, weren't actually there. So they needed smarter tools and smarter analytics to power the advice conversation. But even having looked at that, and we're now seeing that, if you look across the Australian market and others, you'll see this huge debate and discussion around goals-based advice or consumer-centric advice, where we're now attempting to place the consumer at the centre and move away from this culture of selling product, right? But even having done that, we still haven't actually identified the problem that we're attempting to solve, because it doesn't matter how smart my analysis is. If I feed rubbish in, I get rubbish out. And so a couple of years ago, what we decided to do is actually, everyone talks about retirement income and constant retirement income or rising retirement income, but we actually don't know. We don't know what the retirement income profile of the consumers we deal with actually looks like, right? And the real exciting thing to me is over the last decade, we've seen so many leaps and advances in technology and accessibility to data that we can now actually start to solve that problem. So some of the work we did in the Australian market is we started looking at things like banking and transactional records. So we did work with one of the large four banks in Australia. They also have a branch over here. And we started interrogating what a bank account looks like for a retiree and how that changes over time. And what you start to discover is how much they spend, what they spend it on, how that changes. Is the aggregate amount constant, rising? What we actually found was an 85-year-old spends 40% less than a 65-year-old. And healthcare does rise, right? Healthcare goes up, but everything else drops so much faster that it more than offsets it. And the real kind of exciting thing, if you start to think about this demand and sort of, for personalised experiences, is that sort of information is now accessible down to a postcode, down to a street. So when we look at it and we talk about income levels in Australia, I can look at an affluent suburb in Sydney where they're spending $50,000 a year and then compare it to a blue-collar suburb and they're spending half that. So, in terms of sort of, my sort of view and suggestion, I kind of think we actually have to almost start with the basic problem, which is understand the retiree and the lifestyles that they currently live. And from there we can begin to work out how we enhance them. And inevitably products and regulation, all that becomes part of the solution. But if we miss that fundamental building block, then we run the risk of building a whole bunch of things that are not really fit for purpose at the end of the day.
It's food for thought, isn't it? So, look, as we please fire through some questions because we've got plenty of time to be, and you don't need to text it if you can, that would be great, but or call it out as we kind of run through this session. But Wade, I mean, thinking about what you're talking about is actually. And it's certainly our view as well, is that every New Zealander will have a different view of what retirement means and is going to be for them, and it's very hard to draw and see what that picture's like. So what you're talking about is essentially getting more data and information around what that age group is doing in their stages of retirement, because it's such a long time now. Do you think not just having that data, but also creating the information in a way that people can relate to it would be one of the more useful things that we could be doing as part of the industry?
Yeah, absolutely, David. I think, if we think about the challenge that pension industries face generally, and superannuation in Australia absolutely experiences this. It's a government mandated, savings scheme, and so you're lucky if people even open up their statement, let alone pay attention when they do open it to what amount they might have at retirement, right? So we're automatically working off the basis that the vast bulk of people we deal with are not particularly engaged with what it is we present to them. And then when we do present stuff to them, we present stuff in terms that we like, that actually the average consumer doesn't really understand or appreciate. So we present returns and fees and information that is difficult for them to translate into reality. It's only in the last few years that actually in the Australian market, superannuation funds have started to include estimations of income on members' annual statements. But even that, I suspect, isn't necessarily the right solution. I think if you start thinking about where data can take us, one of the powerful behavioural aspects is people naturally like to compare themselves to others, right? So, imagine you have this information about them, you have their postcode, how affluent they are, and you can say, well, actually, people like you are spending this much when they reach 65 on these things, and this much at 75, and based on where you're at today, this is how you compare. So I think that kind of ability to allow people to benchmark themselves in a framework that they actually understand and can personalise is immensely powerful.
Very good. Susan, you talked about incentives, government perhaps thinking about how do we get more New Zealanders, obviously building a nest egg that would create, and it's a difficult environment given the middle income is where the challenge is to build up enough wealth. What are your thoughts on perhaps as a government to be thinking about what they could do to improve that, do you think?
Well, I'd have to say that what we've done in terms of having a tax-neutral environment for saving has had a lot of advantages, and that the way in which the subsidies for the accumulation phase of KiwiSaver are designed are pretty fair. Where you look at other countries and you look at the way the tax incentive structure there for saving, for retirement, benefits those with the most, benefits them the most. So what we've done in New Zealand is to do something that's pretty good for the lower end. I think that we don't want to interfere with that, but we should acknowledge that compared to the rest of the world, we actually don't, as a society, through the taxpayer, spend a lot, so we can afford to do more at the decumulation point. And that's the point of asking, how can we make an annuity product attractive when, as Wade was saying, that people don't want to think about these things. I think they want a solution, and that's why I'm proposing that it's a default solution at the point of retirement.
So product is something that is going to meet a need, and I totally agree with Wade. I genuinely saw what was happening in Australia when I was working for ING, for example, and the products that were there would meet that need, but people didn't understand the value or how that would work for them, and because they seem to be pretty complicated as well. So Ralphie, how do we kind of get that information out better so the consumer or the investor can understand that, and more importantly, what are the other options you think that could be utilised to help build the awareness?
Okay, thank you. I think the first one, picking up a little on Wade's point, was we went out in 2012 doing focus groups before we started and talked to, I think, 600 post-retirement, pre-retirement people up and down New Zealand to try and identify some sensible data. It wasn't enough people for it to be statistically significant, but it was a reasonable amount of people. And that put to bed some myths really quickly. We held the impression that in designing some sort of annuity product for New Zealand, it had to consider something at the end for the family. There had to be an inheritance factor. And just through that simple process, we learned it did not. And inheritance was hardly relevant to every focus group we did. We also learned that at that time, admittedly it was 5 years ago, but in the context of KiwiSaver, everywhere we went, we heard that if I held KiwiSaver at 65, I needed to get out of it because the government might change it. So getting out and talking to people and getting the right information before you start central. In terms of communicating the message, and we've tried very different ways, all sorts of different ways. Seminars are important. People do like to come out, and trust and confidence is so essential. They want to be able to see who you are. The strength of your board is absolutely critical for trust and confidence, and as you know, we spend a lot of time getting the right people on the board. But in practice, if there are 2 or 3 key messages in terms of communicating the benefits of a guaranteed retirement income, the first is it's a very practical way of bridging the gap between NZ Super and what it costs to live in retirement. And that might be $250 every fortnight on Super Tuesday. That sort of languaging is understood. Second step is what everyone seems to worry about is access to their capital. So being able to communicate, either go online, see your balance and pull it out the next day is a fundamental piece. And the third piece is, well, we would never use the word longevity. Mortality seems to be better understood than longevity. People are really aware of having to pick a number of when they're going to die, and they hate it. They just can't do it. So just understanding that the income is not all their income. For most people, NZ Super make up most of that, but both NZ Super and some other layer of income will last their lifetime, as they're used to with NZ Super, is very consoling for people.
I mean, that is a beautiful thing that we have in New Zealand, is that our first pillar is an annuity in itself, and it's a wonderful thing. It's simple, it's easy to manage, it has a lot less complications to perhaps in Australia, and the cost to manage that in the sense of facilitating it is low compared to other options. That said, for many it's probably not going to be enough. There was some questions that come up. So I think, Ralph, you said this, you say home equity is a need. I call it the Hansel and Gretel approach almost, isn't it? It's about having to eat your own home is probably the last option, or an option that for those that at least have got a home and they're debt free as well, and we know that home ownership is falling. I mean, do you see that growing in New Zealand as an option?
Dave, I absolutely do. We would not do a seminar in any town or city in New Zealand where not more than half a dozen people would ask us, how can I get some equity out of my home to improve my lifestyle in retirement? Every single place we go, I think with our guaranteed retirement income, we've tried to innovate. I think there's room to innovate more in equity release. It's not just one way, it's not just accumulating interest over time in reverse. There's proportional ownership, there's lease to die, as they call it. There are a number of different options. And I think, a bit more thought, there's a serious need that could be met in that space.
Okay. I was just going to say, just add 2 quick points to that. So again, one of the assumptions or myths that we tested when we look at the information in the Australian market is there's all this downsizing activity that's supposed to take place. So the first point is, when you actually look at what happens, downsizing doesn't happen. Right, so people want to age in the house that they retire in. To the extent that they downsize, we see them at most freeing up one bedroom. So they're moving for lifestyle purposes, not to create cash flow. And the other interesting thing that I was astonished when we're looking at the equity release market in Australia, and there's a number of providers doing relatively well there, is that my initial assumption going in was that it's people tapping the equity in their home later in life as their existing retirement assets are starting to, run out. Whereas in actual fact, it's the reverse. They're tapping the equity much earlier because they want to supplement their retirement while they're healthy and want to, achieve all the things that they want to do in those early years rather than try and fund the later years.
And isn't that how it's advertised as well? You can have that trip overseas or a new caravan or something.
Yeah, I think exactly right. I think it's and I think it brings us back to the point around communication is ultimately we can talk about guaranteed income to retirees, but that phrase to them doesn't mean anything, right? We've got to talk to them in lifestyle terms. So it's a lifestyle vision that they have for their retirement, and then the products and the tools that help them get there are then just the vehicles.
Great. Another question that's come through is, Susan suggests that we have an opportunity to build a world-class solution. Who are the critical stakeholders needed to make this happen? Who do you reckon?
I really think this does need to be opened up for debate. Obviously, it's the politicians who drive this kind of thing. We do have a retirement commission. Maybe they could be in charge of leading properly researched outcomes on this. I think that going back, yes, product providers, everybody who's in that space, KiwiSaver providers, be really good for them to have a default option. But we just haven't had the discussion in New Zealand. I mean, who do people out here think the stakeholders are?
It's a really good question. I'm sure that we've all got views around this as well. And maybe one of the outtakes of this, perhaps, is if we're really genuine around making a change or difference in this, that we need to have a day on this for the industry as a whole, including public and private, as a perhaps takeout, if there's interest in that. Question here, people are living longer in a way, self-regulating their savings by working longer, which is absolutely correct. I think one stat that always kind of amazed me was when we looked at those working over the age of 65, 43% were still working full or part-time between 65 and 69. 48% were doing it because they wanted to, not because they had to. So, that's interesting around how they are regulating that, they're managing their income. I mean, do we expect, because one of the other problems that we've got an ageing workforce, we're going to need more people working longer anyway, aren't we? And will this perhaps help a little bit with the income and retirement? What do you think?
It's not the solution to living to 110.
That's quite old, Susan, 110. But we might, well, I'm not sure if I will, but some of us might go that long.
I'm not that fresh-faced. I was going to say there's actually some interesting research that was done a few years ago. So there's kind of two issues. One, people do work, and the kind of notion that retirement is you get to a date and work stops and you retire. We just have to put that one to bed because it doesn't happen. So I think that sort of transitional phase is much more the reality. Life is a transition, so unsurprisingly, retirement is a transition as well. The one kind of word of caution on this, I think, is when you look at the statistics for the number of people that retire because they are forced to retire, generally through redundancy or ill health or other means, are actually it's quite scary how high that is. And I forget the absolute statistic, but it's above 20%. Right, so we have to be really conscious that there's a whole bunch of different reasons about why people retire, and sometimes it is through choice and they have the ability to be flexible and continue working, but some parts of the community just don't have those options.
And also a decent annuity can free people up to do the unpaid work that's so valuable.
Yep, and there's a lot of that here.
Yes.
I was just going to add to that from a practical perspective, and I think of our clients, average age is 67, and Wade's comment about communicating about the lifestyle of retirement. A large portion of those are doing work that was different to what they were doing when they were working, is less paid, or they're not getting paid at all. So there is still a material income gap, even though they might be participating in the workforce.
Yeah, no, you're right.
Yes.
And I guess the other thing that comes up a lot in our industry is behavioural insights as well. There was a question that's come up here, and Wade, but it's probably for you as much as anyone on the panel, is this aggregation of data, of your own data itself would be pretty meaningful, wouldn't it, in the sense of, I'm sure we'd all be surprised where our money actually goes or where we spend it, and to see it and see where that money is going may help to see what the future cost is going to be needed to enjoy those same things that we enjoy today. So bringing to life the numbers or the actions of New Zealanders around what they do with their money, do you think that would be and someone mentioned using Yodel as an example to kind of pull that data together. Do you think that would be an advantage as well?
Yeah, absolutely. I think data is in already so many areas of our lives, data is sort of the currency for how we kind of navigate. So the one thing that sort of frustrated me for many years is you get to these conferences and there'd be someone standing up talking about how financial services is going to experience its Uber moment, right? And something similar is going to come along and just disrupt everything. And I actually think the whole analogy around that is hugely flawed, but the one I sort of gravitate towards is we should think a lot more about, say, the Google Maps type experience, right? So Google Maps is a physical journey. It knows where I am today. I plug in a destination and it does a whole bunch of smarts to work out the most efficient way to get from A to B. And those circumstances change. I encounter a traffic jam or there's roadworks or whatever it might be, and then it reroutes me, right? So in financial services terms, The starting point, point A, is hopefully relatively easy. It's generally, if it's an advice conversation, the advisor can extract that information. It's my financial situation today. There's actually a whole range of fintechs out there that use various screen scraping technologies to grab your bank account details and then play it back to you for budgeting and other purposes. Point B in this world is incredibly hard because it's now 5 years, 10 years, 15, 20 years in the future. But that's where some of these other data sources can be really valuable, because now I can get a reasonable estimate on that destination point, although it will change. And I think the fascinating point there is obviously, there's an interest in trying to find data on the subjects that you're dealing with, so New Zealand members in this case. We've done some work comparing Australian data to the US, and the interesting thing, as you might expect in Western countries, is the pattern is almost identical. And the differences that emerge in spending behaviour are down to local regulations and economic environments and things like that. So in the US, for instance, we see spending peak sort of in the mid-50s, which is a little bit later than what we see in Australia. And as we sort of worked our way through, it's like, well, it's because kids have to pay. College tuition is a bigger thing in the US. So kids it takes them longer to become fully independent, right? And then the final piece is then once I've got the right products and the analysis and everything else, I can start calculating efficient paths. And if things change, lifestyles change or market conditions change, I can then come up with opportunities to reroute. Now, the one caveat to all that, which I think was mentioned earlier, is when we're dealing with retirees, we actually also have to factor in sort of diminishing mental capacity over time. So it's very hard to build an environment where we're going to ask an 80-year-old to take a really, make complex decisions or decisions that have a material impact when they may or may not be in a position to do so.
I think it's also interest. I think a lot of retirees and possibly younger people don't want to have to think about these issues. They're not interested. They want somebody else to solve it. And there might be nothing wrong with that. Life's short.
Just add to that, I think Susan's dead right. There's one other thing that's a really common theme for us, is they ask permission. They're dead scared that they'll be 2 days a week if it needs to be to ensure they don't draw down their capital. But for the majority of New Zealanders, it's an important element to contributing to their income, and they need to be given permission to do it, to be given comfort to do it, and the security to do it.
Yeah, you raise a really good point. I mean, long past probably are going to be the days where each generation is going to move along a certain amount of their wealth to the next generation. And of course that's because they're going to need that income or those assets themselves to enjoy all the work that they've been going through. And it does create that, as we're hearing, that healthy tension between generations as well. Just to close up, there was one question here that I really thought was worth perhaps just passing around the panel very briefly. And the question was, what's the mortality, do we think, or not, of having our first pillar being New Zealand Super in the next 20, 30 years? You know from our position, when I was at the Commission, 65 just isn't going to, we didn't believe it would last. We were capable enough to maintain that standard and believed it needed to be moved up to 67 progressively and very slowly. But what do you think are the options, in the sense as right now today, 20 years time, do you think if we don't do anything, will National Super still deliver what it's delivering today?
I think we must protect it as very best we can. And in terms of raising the age, it's not the only way to do it. We could look at the top tax rate. We could design something that meant we could claw it back from the top 10%, save $1 billion without hurting anybody. We just don't talk about these things because we're not allowed to.
Ralph?
A bit of a horrific question. All the income projections we do assumes that NZ Super is going to be here.
That's right. I mean, without it.
Life without it, I can't imagine. Really can't.
So we need it, but do we think it's sustainable as it is today?
A question of choice, I believe. Ultimately, there are only so many tax dollars, and the demographic of the tax dollar is changing. So where does it go? Does it go to support NZ Super? Does it go to healthcare? Does it go to education? It's going to be a constantly moving slide rule of options.
And we give the winter energy payment to everybody over the age of 65, whether they need it or not. We've got to start talking about these issues.
Very good point. Wade, quickly.
Oh, look, the biggest problem I think we face is you have a political environment where people operate on a short-term basis, and they're designing policy for their own purposes. They're not designing policy for the next 15, 20 years when they won't be in power. So we just saw actually yesterday, and thank you for not having a go at me already about this, but we've got a new Prime Minister.
I didn't want to bring it up. But
I've lost count of how many we've had.
I was going to mention the rugby as well.
But he was, thanks. But yeah, so yesterday he was caught on live TV. They had pensioners asking him questions from the street, and someone asked him about the government's plan to take the pension age to age 70. And on the spot he said, well, thanks very much for that. I've actually been discussing this with my ministers, and I can tell you today we're going to revert it back to the old policy. So we're actually now making our pension age lower rather than increasing it. And that is obviously a short-term expedient move from a political perspective. But the challenge with that is eventually there will be a government who is in place that actually has to do something about it, and all we can hope is they've at least got some policy framework that's been edging them towards something so they don't have to make drastic kind of changes to the environment.
That's the last thing that we want to have is replicate what you're doing over there, mate. So we can learn a lot from our older brother from that on that basis of what not to do, to be honest, and that goes with regulation as well. Time's up. That aside, there's probably 2 or 3 things that I think we could take away from this. One is FSC. We could look at using members' data, access of information that could help maybe get that picture better to provide New Zealanders with a greater insight of where they might be, where they're spending money, how they might be able to save money as well. I think we need certainty from government and success governments that follow successive governments to give certainty around this first pillar, because without it we're going to have a real problem. And perhaps thirdly, let's as an industry, both public and private, come together perhaps and facilitate a conversation, but with some action plans that instead of poor old Susan and I coming up here and going on about it every year again, that actually we might have some outcomes. So thank you so much for attending and coming along to listen to us today. I hope that was some food for thought, and hope you enjoy the rest of the conference. It's been a cracker so far. Thanks very much.
Thank you, David. As you mentioned, plenty to take away from a fascinating discussion there, whether it is some sobering statistics from David himself, and 40% of people not having a plan particularly stood out to me, or an overview of the current challenges as outlined by Ralph, and especially the challenges of communicating in an inclusive way, the benefits of experience that Wade laid out for us, and especially that products themselves are not the solution. But I think the key takeout from me will be the optimism that Susan brought about the fact that we have the opportunity now to build a world-class solution, and it's down to us in order to make that happen. So hopefully you'll all join me in thanking the panel for what has been a fantastic discussion.